What's the number one concern from? Is it Fed? Tell us.
Well, I think it's a combination of the Fed and fiscal policy and how the two interact. Right now, we got the debt ceiling up. That's a good thing. We're now trying to figure out how to finance that debt. And so the Treasury has to reload its Treasury general account. They've unloaded $1 trillion, or will unload $1 trillion of T-bills, and they're trying to drive that T-bill rate above the reverse repo rate, so that money will come out of reverse repos.
Why do they want money out of the Fed's reverse repos? It seems to be a pretty good deal for the banks, maybe too good of a deal.
Yeah, so the reverse repos are sitting on the Fed balance sheet, and so if you take the money out of reverse repos, you're not taking out of the banking sector. So you're preventing a liquidity drain on the bank reserves, and in light of bank failures, you don't want that to happen. And they're having some success doing that. But if the Fed is going to continue to raise rates, that reverse repo rate is going to go higher, and investors may want to keep their money parked in that reverse repo rate and not in the Treasury rate, or it would force Treasury to continue to have to try and drive up those rates. So that, to me, is the biggest issue. It is impacting growth versus value. It's impacting the dollar. It's even impacting Bitcoin. And Treasury's had a lot of success over the last couple of days, but their real test will come in the next 3 weeks. You got $80 billion of QT. You got corporate tax collections coming in. So we expect liquidity to be drained in the second half of June and early July, and that could lead to market leadership change.
So that's a liquidity thing that you think is on the horizon. Is the issuance of all those T-bills also a liquidity issue in that the money that's going into those T-bills is coming from somewhere?
Absolutely.
It is coming out of the economy. But ultimately, doesn't it work its way back into the economy?
Absolutely. But we're now financing the U.S. government at an over 5% rate on the short end of the curve. That is going to drive up the net interest costs, which we have spoken about. And so we're just trying to find the least bad option. And the least bad option still has a significant cost to it. It could work its way back over time, but in the short run, you're in a liquidity squeeze. And it looks a lot like Y2K, where the Fed flooded liquidity into the system before Y2K happened, and then they pulled it back, and then you had the tech sell-off. And we're approaching a similar situation
So
today.
let's go to the question of the fiscal side of things. We had the debt deal. We had agreements on what the spending cuts were going to look like. Now it feels as though, through the appropriations process, that the Freedom Caucus on the conservative side of the Republican Party are trying to fight a rearguard action, I would put it, to further cut spending even beyond what was outlined in that deal. Is that what's going on here? And does that augur a government shutdown come September 30?
Absolutely what's going on. We may not have a government shutdown. Let's just think about what we went through. A default is a really bad thing. The debt ceiling is a really bad thing. Government shutdown, we've lived with it for 45 days in 2019, right? So pick your poison. And we're going to have a fight over appropriations. But this is part of the process. And I celebrate the process. I know it's very distasteful for investors. The House may wind up passing a whole bunch of appropriation bills. The Senate's going to pass a whole bunch of appropriation bills. And then the two are going to put those together and try and find some sort of solution.
But it sounds like you don't think it's going to be a macro event, that people will shrug it off because they'll go to government shutdown. I mean, that has to be like a 0.005 impact on GDP.
Exactly. We had really strong GDP with a 45-day government shutdown in 2019. Now, we're in a slower economy, so maybe we don't have that much margin of error. But this is going to be about what defense stocks are going to do, whether defense is getting an increase or not, what's going to happen to life science tools with the NIH budget.
You want to give us a quick, defense up, life science up, or both of them get a thumbs down?
Well, I think we'll go through a continuing resolution for 3 or 6 months. And then we'll come to some sort of resolution. But defense got a 9% increase last year. They're probably going to get a 2 or 3% increase this year. They're a privileged position in the budget right now. And those stocks have really sold off since the Republicans took over the House in January and the market began pricing in some of these defense cuts. All right.